So we were real estate geniuses for like a year and a half before we got our ass handed to us by the market crash in 2008. Doing 10 flips a month is no joke when it comes to the marketing side, when it comes to the operational management side, the property management side, the resale side. There's so much that goes into it that I didn't have a life. It's like 14-hour days doing this versus the schoolwork is like memorization stuff that you're like, how do I apply this to life, right? Like, how do you apply calculus to life? And I was bored out of my mind, right? I remember wanting to cry going to work, going, I can't do this monotonous crap every day. It's just horrible, right? It's so important. And you don't spend what you think you spend. You spend a totally different amount. So yeah, let's buy this building. This makes sense. We've done the math. Let's go do it. And it's $10-20 million building. And they're just haphazardly talking about buying $10 to $20 million buildings, which immediately got my focus. Real estate was always like in my mind to a degree, but I wasn't sure how to start or get going doing that. I'm like, should I open a bar? Should I do something else? Like what the heck should I try to do?
Hi everyone, this is Jack Allwild with another money episode. Today we have very special guest Mathew Owens. He is a CPA out of California, a real estate investor and owner of OCG Capital. Matthew, welcome to the show.
Thanks, man. Appreciate it. Thanks for having me.
Yes, that's great. It's great to have you on. You've flipped over 1,000 properties, raised over 150 million in capital, and have now lent over 135 million in capital. But before we get into those, I do like to start off the discussion by asking, what was your relationship like with money growing up?
It's funny. My parents, my mom was an engineer, and my dad was a CPA. And so what's funny is that my mom was much more, I'll say, much better at saving money than my dad was. My dad would go spend a bunch of money and stuff like that. At the same time, he was really good with other people's money and understanding and teaching us like how to balance a checkbook and stuff like that. In college, when I was taking accounting classes, he gave me more homework to do, during the summer to mess with me. So it was always there and available. We didn't actually have a ton of money growing up. We were a middle-class family, scraping by in a lot of ways through those, but we didn't have a lack of food or anything like that. We didn't struggle like crazy or anything, but it was always prevalent. My grandfather was a real estate investor and an attorney, so he taught the family a lot about real estate and kind of entrepreneurship in different ways. And so being able to see that, I'm a lot more like my grandfather than I ever thought, so being the real estate investors in the family, but it was really develop cash flow strategies like this. And I didn't see it until later on when I was reading different books and I had these aha moments, right? Growing up, it was always there, but it wasn't necessarily like crazy prevalent where we talked about money all the time or anything like that. It was just like the way I grew up, right? Try to be prudent with your money, try to save your money and stuff like that. That mentality was passed down, right? So
We're looking back, when you talk about like your grandfather and real estate, was it more learning like on the go? Like what was he like taking you to properties, or was it more just discussion around like the dinner table?
yeah, it was more discussion around the dinner table, right? Like my grandfather put together, he didn't have enough money to buy his first apartment building. So the broker that was doing the deal for him actually put up the extra down payment for him to be able to finish it. And they partnered with them on that deal to get his very first apartment building. And he just thought, hey, I got to go and buy these assets. And then when he passed away, he was making $400,000 a year passive, coming in from these apartment buildings, which enabled him a comfortable retirement, So we saw all this occurring, and everybody was like at awe that he was able to achieve so much in that space, and be able to see that cash flow coming in like that is really powerful to say, wow, there is a way to do this. But it wasn't talked about like crazy, other than estate planning, how to not pay the government money, that kind of stuff. That's where I get my anti-government hate from, So
Can you describe your transition from like, I don't know how involved with being a CPA you still are, but how you went to flipping houses?
Absolutely. So I grew up, went to college at UC Santa Barbara, went and got my accounting degree with an economics degree from UC Santa Barbara, and really didn't know a lot about accounting or economics until I started working at a job and actually at a CPA firm doing taxes and audit. And then I really started to put together the pieces of auditing and taxation versus the schoolwork is like memorization stuff that, you're like, how do I apply this to life, right? Like, how do you apply calculus to life unless you're an engineer or doing something high level like that, right? And so seeing it in real time is like, really being able to put it together and actually working for firms that, did a lot of real estate work and real estate audits and, that kind of stuff, saw me some of the inner workings of real estate where these guys were buying these giant apartment buildings with, I'm sitting in the room with the COOs and chief operating officers and CFOs where they're just, yeah, let's buy this building. This makes sense. We've done the math. Let's go do it. And it's $10-20 million building. And they're just haphazardly talking about buying $10 to $20 million buildings, which immediately got my focus. I started working for some smaller firms, seeing the inner workings of businesses, doing internal control work and seeing different types of businesses out there to do. But I was bored out of my mind, right? I remember wanting to cry going to work, going, I can't do this monotonous crap every day. It's just horrible, right? Just to do that kind of work. And I just wasn't enjoying it. It wasn't my personality. I was really good at it and understood the math and the numbers really well. And, I say my best skill set now is like financial modeling, where I got these two 47-inch wide screens behind me to do that. But I was just bored and going, I gotta have something else, but I didn't know what to do. Real estate was always like in my mind to a degree, but I wasn't sure how to start or, get going doing that. I'm like, should I open a bar? Should I do something else? Like what the heck should I try to do to make money and get out of this position? And then my stepbrother came to me one day and he's like, hey, you got to go to these classes I just took. They're amazing. Come check it out. And I was, I said yes, but I was totally going to flake on him, of course. And he calls me the day of and he's like forcing me to go. And I go to this pitch for a real estate course. It was like a 2-year type real estate course for like $16,000. And I ended up buying the course. Was extremely interested in seeing the people around real estate, where a lot of them are entrepreneurs. A lot of them are there to help everybody else and find resources to help each other make money. Yeah, there was some salespeople there and stuff like that too, but the general overall nature of the people in the group were helpful and trying to teach everybody the strategies they understand and know about, right? And so I was immediately drawn to that, and immediately started taking these courses. And I got my first deal under contract where I thought I was going to make 30 grand and I'm making 20 grand on the deal. And I quit my CPA firm job. I was like, this is like 30% of my salary right now. I'm out. I can't like stay and do this anymore. And I literally just quit my CPA firm job. I probably had 10 grand in the bank and, and some savings as well in my 401k and stuff like that. But not, anything major. And then went out and started this work with my two stepbrothers that were both computer programmers and electrical engineers. Did everything wrong. We got an office with the World Trade Center in Long Beach on the 23rd floor, awesome view, sold a lot of houses. And we started selling houses really quickly because it was 2006 when we did this. So we were real estate geniuses for like a year and a half before we got our ass handed to us by the market crash in 2008 and late 7 and 8. And, we thought we were, geniuses, and realized with a massive punch on the face that we were not, geniuses. And I ended up, taking the hit. They went and got jobs, and then I went and hunkered down and tried to push through. I don't get me wrong, I was looking at the job boards going, but that just was still so much pain to me that I couldn't go back. And I started hunkering down and started doing joint venture flips and holds with different investors and building in rehab management fees to keep the lights on and things like that on my side, where I would make like $5 grand a pop. And we started doing 5 at a time. And that's how it grew to doing 1,000 houses. We started doing 5, 10 a month consistently, and doing 10 flips a month is no joke when it comes to the marketing side, when it comes to the operational management side, the property management side, the resale side. There's so much that goes into it that I didn't have a life. It's like 14-hour days doing this stuff consistently until I learned how to delegate better or set up the right teams, which is really the key to all business, is learning how to do that and set up the right processes and procedures and how to be a leader, right? Instead of you just grinding it out and pushing, right? So, but anyway, sorry, long-winded answer, but that's the story.
So I mean, when you're talking about systems and processes, which ones would you say really move the needle? I mean, I envision you like sending mailers out, or how are you acquiring? And then on the sales side, what systems did you have to help you out?
Absolutely. So one, you have to have lead flow coming in on the property side, right? And the way you do that is a number of ways. First, if you don't have any experience doing this, you have no business doing mailers and pay-by-click marketing and things like that to try to find buyers coming in or using AI to do that. You're going to spin your wheels and waste a bunch of money because you don't have the other processes down first, right? You're going to waste a ton of time and money because you're not going to have everything else dialed in to actually take it down in the first place. So the first place I start is relationships. Find every wholesaler I can, find property managers, contractors, lenders, title companies, attorneys, CPAs, all the connectors in the space is who you start to develop relationships with, and you start going to investor meetings and things like that, and you start to be around people with deal flow, and you start getting those deals sent to you in your inbox over and over again consistently, and then you start having to analyze hundreds of deals every single week, and you can do quick analysis. We have like a quick analysis sheet on our website where people can download it and put in 5 numbers and know if they have a flip and what their hold numbers are going to look like as well. And so there's ways to streamline that process on the analysis side. And then it's a matter of, if we're doing pay by click and direct mail and stuff too, how you get the phone ringing, you get a lead coming in, how do you analyze it quickly, right? No matter where it's coming from, how do you get that lead analyzed quickly so that you can get out to that property, understand the renovation, do your homework on the inspection side of things, and then get that information back to be able to plug into your numbers and say, this is where I'm at. Because pre-doing that, you can look at your market value, you can look at your rents, you can look at your general estimated costs and everything else and put a inputted rehab figure and come up with an idea, but that rehab figure is your final figure to know what that number is. And so you get all your numbers ready, and as soon as you do that rehab figure real time, you can know your numbers immediately and say, I put in 50 grand in rehab, oh crap, it's 60. Take my bottom line number, drop it by 10, and don't forget about your profits. A lot of investors, they look at this and they're like, they forgot to put their profits in, right? So on the back end, and really nowadays, some investors are okay with like 8 to 10% margins. I really think you should have like a 20% margin on your cost in this kind of a market right now, to be very conservative, because we have kind of a broken market right now with buying and selling properties. Not a lot of buyers, not a lot of sellers, a high interest rate environment, lack of affordability, a lot of problems there. So you want to reduce your downside risk exposure by having additional buffer room when you're doing these deals, right? So that's kind of the process that you have to go through. And so you have to analyze your rehabs really, really quickly. You got to be able to walk through a property and come up with a general estimate of what your rehab is going to be with plumbing, electrical, HVAC, roofs, appliances, all the major systems, including foundations and that kind of stuff. You should be able to walk through and know what major things are going to come up and based on the age of the property and stuff like that, to really redo the property right. And then add a 25% buffer on top of that, and have your cosmetic idea down, right? So if anybody's new, trail another contractor, trail another real estate investor, go to Home Depot, go find the prices and stuff like that, go to Lowe's, go to these places and find out what materials costs are, and talk to them in depth about what the actual expectation of labor costs are and what their markups are, so you can come up with a room by room breakdown of that renovation and streamline that process to really be able to scale, because that's one of the hardest parts, right? And then it comes down to, in the process piece, you got all your numbers, you get it under contract with the property, with the paper at the property. If you're talking to a homeowner, the purchase contract, or immediately going out to the wholesaler or whatever contact you have, or whoever the buyer is, to get that under contract fast, right? Then during the 2-week close process, you're still dialing in all your rehabs. You're trying to set up utility inspections. You're trying to finalize your rehab bids and everything else during that 2-week close process, pull title and everything to get that closed, and also line up your money. So before you can close on that deal and feel confident that you're going to do that, you got to have the money lined up, right? You need to be able to, if you don't have the money yourself, you're going out there talking to investors about the ideal property you're looking for, and here's the math breakdown and what exactly I'm looking for to make these deals work. Would you be interested in putting the down payment money down, or all of it down? And then having your construction lenders on the side there and things like that, if you need that stopgap or that additional funding source to do that, right? And so having those on deck to be able to go to as well is all lining up that money beforehand to be able to close in 2 weeks and then immediately start that renovation where you got utility inspections happening right away. You're in the property trying to get demo done and all that stuff immediately, because you could spend a lot of extra interest in that period of time between close and starting the rehab if you don't have all your other ducks in a row right away to be able to immediately move forward. Which a lot of the fix and flip business or fix and hold business comes down to efficiencies, because you have to dial in your renovation costs, and part of those costs are your interest hold costs and things like that, and the timing of doing this. So all of that is what goes into it up front. Then managing the rehab is a whole nother game plan, with quality control inspections on the back end, redoing your market values at the end of the rehab and stuff like that, and dialing those in, having it handed off to the realtor that needs vetting in themselves. If you don't have a good realtor, you need to be able to vet them and understand what questions to ask. If you're handing it to property management, same thing. Team members need to be vetted in depth, background checks and criminal checks, and a slew of questions to ask them about how they make money and incentives for performance and things like that. So these are the things that you want to dial in and put in place as a process, so then your team can now follow that process and you actually have a chance of doing this efficiently. Because if you try to do it all yourself like I did in the beginning, you're going to be really inefficient. It's going to cost you tons and tons of money learning this unless you have that dialed in, right? So it takes a lot, and it can be a major animal doing fix and flipping and being direct to the property, right? So
In terms of efficiencies with the contractors, what would be some questions you would ask prospective contractors? And then over time, I've talked to some people that use like the same paints, the same tiles. Like, can you talk through some of those things that streamline the process?
Absolutely. And it depends on the type of project you're doing, right? If you're doing high-end properties in Beverly Hills versus cookie cutter rentals in Tennessee, for example, that are all the same, it's a completely different design process and upfront process on those high-end properties, because each one's unique. You got to match it to the neighborhood, match it to the comps, make sure you're trading apples for apples on those things, right? Versus rental properties, you're like, hey, I want to do dark gray paint, or at least maybe not super dark, but something that's not going to show scratches, right? I don't want to have white paint or light paint that I got to repaint every time, right? You want to look at the flooring and the carpets and durable type stuff. You're trading your materials on that side and saying, okay, how would I cookie cutter this? I don't have to have high-end crazy customized cabinets, right? I can have stuff that looks really clean and really good. What kind of countertops am I going to do? Not just for you're going to go put marble countertops in a rental property that will get destroyed, right? You're going to put something that's more durable, maybe, that is, you might still put granite in and stuff like that, but at the same time, durability matters a lot when you're trying to cut down turnover costs long term, right? You're looking at it from that perspective on a rental property, right? And so when you're dialing these things in on the construction side of things, one, you got to vet your contractors. We got stolen from by a contractor a few years ago for $500,000. There was a professional con artist that literally was submitting to us fake permits, fake sign-offs from the city, fake pictures, fake invoices, and everything was perfect, right? And so our team got duped. I got duped by it because we gave him one extra draw that he shouldn't have gotten, because all of it was fake, on like 8 big projects that we had going for us. He set us up by doing 2 jobs perfectly with no punch list, nothing wrong. They were smaller jobs, and we're like, great, send him to this, piece. And I have to tell you, it was just my mistake of not following my own procedures, or my team's not following my procedures in this way, right? Background checks, criminal checks on contractors every time. Asking for 3 or 4 referrals of other people that they've done the work on, and any issues that came up during that process, that they have overruns, did they do it on time, actually calling them to ask these questions. In addition to that, making sure the contractors have the ability to break down the bid in detail. So many times someone gives you one number or something like that, and you're like, how do I know this number's right? Did you get quotes for the plumbing and electrical and HVAC? Did you include new windows or not include new windows? there's a roof new or not new? Do you doing the line to the street in the, you know, all these things where you break down the individual cosmetics in each room, but you break down also the major systems in each room. And then you want to have contracts in place for these contractors with general liability insurance, workers' comp insurance for their guys and things like that, so that you don't get screwed by a lawsuit down the line, and you make sure they're professional. I also like to get lien waivers during that process so that I know they actually did pay their guys. Because if they have an outside sub on a plumbing job, for example, and they don't pay them, the plumber's going to go put a lien against your house. So you want to get lien waivers every time to make sure that happens. And if you're not comfortable with that contractor's ability to manage money, which is probably one of the biggest problems for contractors across the board. These guys are out in the field working on their hands all the time. They're not necessarily the most financially astute team, you know, in place. And so if you have if you're unsure, then pay those contractors directly and get lien waivers from them directly, so you know those team members get paid, and you make sure that every time they're submitting receipts for materials and stuff like that, and you do a reimbursement system where you're like, you might go and send them $10,000 or $20,000 for materials purchases, but you want to make sure they're giving you those receipts, and you're adding it up saying anything you don't have a receipt for, you're not getting paid for. In addition to that, I put things in the contracts like, hey, if you finish early, you get bonuses. If you finish late, you got a 2-week or 3-week window. After that, we start charging you because it's costing us interest on our side. Some contractors don't like this. The professional ones are not going to have a problem with this, you know, across the board. But the professional ones are going to be more expensive, but they're also not going to necessarily have overruns and things like that that come up, and they're not going to have major problems where they forgot items. And, you know, you're getting underbid for a reason from these guys, right? They might have some labor efficiencies on cheaper people, but for the most part, you know, they're not having workers' comp in place. They're not having general liability insurance in place and things like that if you go cheap on the construction side of things. So that piece is really difficult to dial in, the construction aspect. And I highly recommend, if you're not on the ground in a market, you have someone else that's doing inspections every time there's a draw that you're doing. So you're like, did this guy complete these parts of the items that are outlined on his bid specifically or her bid specifically? Then okay, great, you get reimbursed for those items. These ones aren't done. Hey, you bought the materials for the windows and the cabinets, but none of them are installed. You don't get that payment until after they're installed, because materials have a tendency to walk off the job, you know? So it's like, until they're installed, you don't want to pay those items. And it's hard in the beginning when you're first starting out with a contractor to tell them these things, to say, these are kind of my procedures. I really want to be clear with you up front about how I do this, because we've been stolen from so many times in the past. We have specific procedures that we're going to need you to follow in order for us to do this, right? So that's kind of the key to doing that, never paying them too much up front on that project as well, right? So they have a tendency to go job to job, you know, as well, instead of just working on your job, you know?
Yeah. So this first flipping phase, I mean, you talked about 2007 being, you know, catastrophic, I guess, for you stepbrothers. Looking back, I mean, was it just a matter of being like over levered, or what can you like point out that maybe could have been a sign or could have been avoided?
Yeah, so one, we didn't have enough cash in the first place. So we were banking on our flips, which were happening consistently, and they were working, right? And everything seemed to be working. We would buy properties, renovate them and tenant them, and then resell them to another investor with 100% seller financing, and they would immediately refinance and then pay us off with a rate and term refinance, right? That was super common in like 2006, 2007. That was an awesome exit strategy because it allowed them to have no money down on a project, right? They were still getting like 8 caps and 9 caps on properties and things like that as far as cap rate goes. So they were cash flowing well, even at their higher leveraged amount, right? Then in like 2007, all of us, we had about 40 of these going at the same time. And we were like, we had just put all of our money into a bunch of these acquisitions to go do more of these. And we're in the process of doing that. So we're cash poor when the lending market stopped completely. And we were taking these projects. We had already done the seller financing. They were in the process of refinancing these properties. And then the lending market stopped and none of them could get refinanced on that. And the interest rate was high because we were using investor capital and things like that to do that. And so we had to take back a lot of those assets, if not all of those properties that we had just sold. And we're like, great, we're screwed. What do we do? How do we get out of this? We're not getting cash in. They're all put into this properties, and we have investor capital that all of a sudden looked like the market dropped like 20%, but it bounced back like 6-8 months later to a degree because there was no liquidity during that time. So only thing that was selling was cash sales and things like that. There was no appraisals happening because bank financing was stuck for a period of time, right? And so during that process, we ended up taking like 20% haircuts on properties and selling them off, and then going through, and so we were going to be about $200,000 short for our investors. So I had 290 grand worth of empty credit card lines and a 790 credit score because I'd never missed a payment in my life. And of course, at that time, they're like, here's more credit cards. Here, you can have as much as you want, you know? And so I took out 200 grand on my credit cards, paid my investors back, and tried to float it during that time. And that's when I started, hunkering down and doing those, fix and flip type, projects and things like that, where I was building in acquisition fees into that process and paid. And a lot of those investors that I took the hit for, they saw what I did, and they started reinvesting with me, and then they started telling their friends, and I started asking for referrals and getting out there and doing presentations consistently. And I was going to 4 to 5 network events a week, every week for like 2 years to just grind my way out of that process. And, taking that hit, taking that giant L, and my ego destroyed at that time, which I thought I was the shit, right? I was like, oh, we're killing it. We're at the office of the World Trade Center in Long Beach, 23rd floor. We're flipping houses, and realized, all of a sudden, major humbling component, part of me, where I had a 790 credit score that took a major dip, at that time when I took that hit, and grinding out of it, of course. And it really taught me everything I need to know about business as far as standing back up and focusing on how strategies to move forward instead of dwelling on the pain that had just occurred at the time, which is a hard thing to do, right? Standing back up is the key to your success in any business and real estate and life in general, right? Life is going to knock you down like crazy, and you got to be able to grind through that. And so after that occurred, it made my mindset a lot stronger for being able to actually go out there and do more. And of course, I've taken additional hits after flipping 1,000 houses. I've taken my hits, so as well. And so you learn lessons the hard way. You're just able to wipe them off your shoulder and say, solution, how do I make the money back now? Move forward and take care of it, right? You try to not have the emotion, even though it's hard to not have that emotion. You got to get your mindset right, and meditation helps. A lot of different strategies help with that, mindset shift. So.
Awesome. Yeah, I mean, one theme that keeps coming up talking to you is like just the relationship building aspect and the compounding of the relationships over time. And I'm guessing that's kind of what led you into the lending at a certain point.
Yeah.
Can you talk about how you transitioned into the lending side?
Absolutely. So first in 2008, 9, and 10, and through 12, I'd say even, it was hard to sell houses, right? Property values were continuing to drop. People were scared of real estate. And so I took a weekend course on how to start off my education in the lending space on how to do seller financing and those strategies. And I started doing seller financing to sell properties to people's IRAs and their 401ks on 15-year fully amortized financing. And then I started selling that debt off to other investors that wanted the cash flow from those debts. And so it was another way for me to exit houses on my fix and flip journey, doing that, including helping people with 1031 exchanges, where, they'd come with a 1031 and I'd hit their sales prices, their loan amounts on seller financing, and their down payment amounts, and sell a package of properties at a time that way to, investors that want better cash flow than what they were just trading up into or from, right? And so that's how I started. And then through my networking, we run a nonprofit organization called For Investors by Investors, where we teach financial education and real estate education that we started in 2008. And we were doing reoccurring monthly meetings, and doing that consistently and getting out to these networking events allowed me to build a lot of investor relationships for capital. And I stopped needing that much capital for my own deals because I had that all solidified. And so then my friends started coming to me about needing capital for their flips. And so I started going and lending it out and learning that space and going to all the attorneys to understand the lending laws in every state, and go through that method and that process for being able to lend in other states and be able to do these types of strategies in other states. I don't lend in California. I'm not licensed to do it here. And so I don't touch California at all, because California is a whole nother animal in itself. But we started doing that in other markets and making interest rate spreads on that, on those markets. And so I might utilize investor capital at 8 to 9% and go lend it at 12% and make an interest rate spread on that capital consistently, right? And so that's what led me into that lending space. And now we do a lot of buying a debt where we don't necessarily originate anymore. We just buy the debt and make the spreads, and now we know how to underwrite it and all that. And the lending game is a whole nother game. You realize after running a property management company that we did and running a lending business, I don't trust anybody anymore. You're like 90% of people are bad with their money. So you got to be real careful with that piece, so.
So now you've created like underwriting systems and procedures too. And can you kind of describe like what your team looks like now on the lending side?
Yeah, absolutely. So it's an internal team with we have multiple people that work for us. My brother is my partner involved. He's my CFO and accounting team. He does pretty much all the accounting. We have some outside bookkeepers and things like that help him, of course, as well. We have one of my chief operating officers' son on my team. He actually is my brother-in-law and also a finance major, and really, really understands the business. Been with me for over 10 years now. Rick Wang on my team. He does a lot of my underwriting, helps with a lot of my capital raising, helps a lot of my investors with understanding their investment options and, the strategies that we deploy to help them in all these ways and how to create financial freedom for them, whether it's investing in, property like mobile homes or multifamilies or single family houses that we have available, or investing in promissory notes and those strategies. I like both from that perspective. And so he helps with that piece. We have construction managers across the country. We have property management teams and asset managers on our teams. We have VAs on our teams. We have transaction coordinators on our teams. So we have a lot of different team members across the board, probably 15 internal team members right now, and then team members in each state that we're doing business in. And we're probably in 15 different states right now, doing these types of strategies. So that's the internal team piece of this that we work on. And I'm still trying to buy back my time and do that kind of stuff, and I've been able to step back quite a bit, but relying on other people for a lot of the asset management and that kind of stuff, and the operations management, which is difficult. But we do a bunch of different funds also, where we raise money for different businesses and different funds, so my investors can diversify in all these different asset classes, different markets of the country and things like that. So
You mentioned you lend in 15 states. What market specifically, or are there reasons that you lend in those states particularly, or steer clear of others? And then, like a macro view on like cities, states.
So the number one thing in these states that you want to be careful about is teams. Do you have construction teams to take over projects that go bad on the lending side? Do you have property management teams also in those markets? Do you have other people that can be, I'll say, roamers, or, construction management teams, or a person on the ground that can help you with those ways? You want to build your team in the market first. So we started in the markets that we knew. One, we didn't need to be licensed to do business purpose loans in those particular states, so we stuck with those states, right? And we had to get the right attorney advice in those particular states. We also went through and made sure, when we're looking at the cash flows, that, hey, what's my cash flow at foreclosure costs in these particular markets? And do I have teams set up like in Tennessee or Missouri or Georgia or Indianapolis, Indiana, or some of these, key markets? They cash flowed better, and we already had teams set up. So we started in those particular markets that didn't require that licensing, that were in, we already had the teams in place to do that, right? And we could just take over if something goes wrong with those projects. And boy, have we had to take over properties in the past, for sure, as well. And that's a whole nother learning curve on the lending side, how to take over a property and get it off your books and go through the foreclosure process and everything else. You learn, some hard lessons that way, not to lend to too many people or too many projects to one person, for example. Maybe, checking their background checks and their criminal checks, going through the due diligence process on if my foreclosure costs, what is my cap rate on rents? And ours is typically around 10% on our rental values. So if I had to take it over and rent it out, I'm going to make, call it 8 to 10% in cash flow on my money, in that kind of environment. And that's what I really try to look at. And in addition to that, you got to limit your loan to value, right? We're usually at about 70% loan to value. So that if we have to take it over, put another 10% of money into the project to finish it off, then and resell it, we're still going to at least make our money back on these projects, or a little bit of extra, including the interest we're paying and stuff like that, on the back end of that note. And so we go through and analyze it from that fashion. And you really want to be breaking down the rehab, doing your right, inspections on those renovation draws and things like that. And we hold back the renovation draw and 6 months of interest, so that when you're doing those draws, you do it as they complete it, you fund them what they completed already. So that way, that project will finish completion. But the underwriting up front, the market values up front, appraisers are not always right in this business, so making sure that the appraisal's done correctly and everything else, you agree with it, and you agree with the renovation figures and all that kind of stuff. Dialing that in is really, really key on the lending side from an operations standpoint.
Okay. Interesting. Yeah. Lots of, you have so much experience. It's really fun to talk to you. I feel like I would be heckled if I didn't ask the CPA some tax strategies. So what tax strategies can you provide, the regular Joe Schmo real estate investor?
So this is a question I love, because I hate paying the government money, So and at the end of the day, some of the best strategies are via cost segregation studies that you get done on projects. So whether I buy a single family house, or if I buy a multifamily property or a mobile home park or anything on the real estate side, you can then go through and do a front load the tax benefits into year one via a cost segregation study. You're picking apart the property into a bunch of little pieces, like the flooring is worth this, the lighting is worth this, the furniture, the appliances, everything's worth something. And instead of writing that off over 27.5 years for depreciation, you turn that into 5-year and 7-year and 15-year property that then can be a bonus depreciation all in year one. And so you can get 20% plus of your purchase price of your building down as a tax deduction in year one. A couple years ago, I bought a mobile home park, and I put $600,000 in, and I got a $600,000 year one tax deduction. Now, you can only take this against other passive cash flow, right? So against other rental income or other passive investments that you have, right? First, then you can take it up to 25% of your, or 25,000 on your salary, assuming you're not phased out by making too much money, and then everything else gets rolled forward into future years. And if you sell the building, you have recapture of that. So you want to do this only on properties that are long-term in nature, that you're going to hold long-term. Now, there's other ways to create more passive cash flow. Like we do lending over here, where if our investors are investing in properties with us and the lending side, our lending business is considered ordinary income and not interest income, because we're in the business of doing loans, right? So that's business income. And so passive LP members or limited partners of our funds, which is our investors, then get passive ordinary income that can be taken against these tax deductions too. So I teach people to invest in the promissory notes, because you get consistent cash flow coming in, and it's ordinary income like that to be able to take these tax segregation or cost segregation deductions against. And then investing in the property side too, because the tax benefits, the appreciation, which is basically an inflation hedge, the ability to borrow money against the asset and leverage it, of course, and of course principal reduction on that loan. All of these things, including the cash flow, is there. Usually on the property side, you have a value add period where you don't make as much cash flow, and then it starts cash flowing long term, versus the promissory notes are set consistent cash flow to cover your monthly expenses. Now it's like wealth building versus cash flow, and I think both are important. You can get the cash flow from the properties, but it usually takes a little longer to get that cash flow. So these are the strategies I implement with my different investors and try to teach them about from the tax side. Now, there's also other tax things, like if you're going to sell a property and try to mitigate the taxes, you can do a 1031 exchange, right? And do that and trade it into another asset. Or you can do seller financing on that property and do an installment sale, where you only pay tax on the down payment from your buyer, and then everything else from your profit, you can do an installment sale and claim it as they pay the loan off over a period of time. So it spreads out that gain over a long term and defers that gain over a long period of time, right? So it stops you from bumping you up into a much higher tax bracket, things like that as well, that can be highly beneficial. And you can actually get a pretty good return on investment if you do like a wraparound mortgage, which is keeping your current loan in place and reselling it on seller financing or on a land contract or something along those lines. Got to be careful about the due on sale clause on the mortgage and things like that. So I don't transfer title and I do a land contract where once they finalize that contract and pay off my loan, that's when we transfer title over to them in that way. And, we're staying on the insurance just like that in the meantime as well. So, that these strategies are awesome strategies from a tax mitigation side. Now, there's always other things like that are basic tax strategies, like paying your kids a salary, paying, putting money into a 401k, putting money into a health savings account and stuff like that. Of course, I even invest in property and other assets right inside my 401k so that all that profit goes back into my 401k tax deferred, so then I can go through and reinvest and have that snowball effect without having to pay the tax consistently like that.
Yeah, I know. I've heard. I think Pace Morby talks a lot about that. Those seller financing, those RAS. And are there any like real estate professionals that you really like gravitate to in terms of learning and more resources? Just curious who you listen to and read.
I think PACE is a good one for, different types of strategies. The more tools you can add to your tool belt, the better. There's a guy named Brandon Turner out there that used to be the host of Bigger Pockets. A good friend. I have a lot of internal mentors, like a good friend of mine, Jeremy Roll, that taught me the syndication space. Hunter Thompson with that he runs Raise Masters, that teaches people how to raise capital and stuff like that across the board. There's a lot of masterminds I would highly recommend, like Investor Fuel or Capital Collective or Collective Genius, for example. These things are great sources to massively increase your education across the board and be around the right people that all have opportunities. Every time I go to these masterminds, the opportunity threshold goes through the roof. Like I have to tell people no all the time. Like, I can't raise for your deal. I can't be involved in any more deals because I have like 5 funds that we're launching. We're about to launch a short-term rental fund right now. We're doing 18 high-end short-term rentals. We have our different lending funds out there. We're doing accounts receivable financing where investors make like 20% on their money, which is pretty cool, for like a 3-year term. So there's some really cool strategies out there. And if you understand the risk, how to mitigate the risk, how to do the homework on the operators that are running those funds, where you're doing background checks and criminal checks and understanding all of the different due diligence categories. We have a 200-point due diligence checklist investors can go to on our website. My website is MathewOwens.com, with 1 T in Matthew because my parents couldn't spell. So, but yeah, MathewOwens.com. We have a 200-point due diligence checklist. Whenever I'm investing with another operator, I go through this checklist to be able to see what things I should be asking about that operator, about the deal as a whole, about the legal docs, the market, all those different facets of the deal before I invest with them. So a lot of cool strategies out there to invest in as long as you do your homework right.
Great. Yeah, I really appreciate you sharing all of your knowledge with us. I do like, as we're winding down, it's a fun question. But what is the best and worst personal finance advice you've either heard or received?
So the best personal finance advice that I've ever received is to make sure that you have your personal budget in order at all times, because what happens is what your final target is from a cash flow perspective, and saying this is what I have to cover in cash flow plus inflation that's going to occur on these expenses to be financially free. And if you're meticulous at tracking what you think your budget is versus what your actual is, and then you're able to build in 12 months of expenses and plan for those big ticket items and pay yourself first with the profit first method, where you're putting money aside every single month to cover these things, and then you see what your net budget is versus actual, and you're paying attention to that. It's insane how fast you can get to your financial freedom goal, because that's in your head at all times, right? So that's probably some of the best advice. Some of the worst advice I'd say is invest in mutual funds and your 401k and those types of things, because they take like 60% plus of the gains and broker fees and things like that, and they make money whether you're making money or not in these mutual fund type transactions. And I think Tony Robbins had a book about this where he talked about the breakdown of this specifically, about how bad it is, because the brokers basically make all the money and take no risk, involved in those transactions. I personally don't invest in syndications or other deals unless there's incentive for performance, where I get paid first, a preferred return, and then the operator gets a split afterwards, right, of that profit after that occurs. So that way I don't like the lack of performance-based incentives in my investment portfolio, right? So that's why I don't do too much of that, 401k investing stuff, or, traditional Schwab type stuff, right? So
I like the kind of the sentiment, like whatever gets measured gets managed. I like the tracking for sure.
it's so important, and you don't spend what you think you spend. You spend a totally different amount. So having that dialed in to know what it really is every month and reviewing budget versus actual is imperative to do that.
Mathew Owens, I greatly appreciate your time. Why don't you tell the audience where they can go learn more about you? I know you mentioned MathewOwens.com, but anywhere else?
Yeah, that's the best place to go. MathewOwens.com with 1 T in Matthew. We have tons of different tools on there: the due diligence checklist, the quick analysis sheet. We got master classes on how to raise capital, find deals, and analyze deals. So we're just an open book and trying to share information with people on these things. So
Awesome. We'll have links to all those. Thank you for your time.
thank you.